that. So we'll get ourselves underway. So building a rule-based trading plan. I need to go through this very quickly. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. So you must consult a licensed advisor before acting on any information you may see or hear. A little bit of background about myself. We all kind of know that. A little bit more background about Ivan. We kind of all know that as well. We're working with the Melbourne group here on trade probability and the setup. Last week and in the Melbourne workshop we looked at this, that there is a situation often we find what we need for a trade setup that would take us into a trade, and it could be a couple of indicators. It could be standout day from a group of periods in the background. We talked last week about pivot points and those types of things. I'm going to go a little bit further with that today, but essentially something sets you up to say, look, this is what I'm looking for. Even if it's that report on a stock, when someone says, well, this is a great stock, you should buy this, well, show me the evidence why I should buy it here. So we came up with this here and made the statement that really what occurs here should be based on some statistical background, as simple as it might be. And then we really don't know what's going to occur after that point, but there are a couple of things that we do know. And they're we do know at this point is the percentage of the account that we're going to risk, which is the R value, the risk value, which creates our position size, and the entry price and the distance to our stop, our initial stop loss. They're the only things that we know going forward in a trade. So this doesn't help at all. This doesn't make the trade work. It doesn't make it a better trade than the one that occurred last week. It doesn't stop a stock from falling. It doesn't stop the stock from rising if you're short. What occurs after your entry point has to be a rule-based function. If it does this, then I will do this. If it does that, then I will do this. And in building these simple statistics, it'll give you a little bit of insight into that. So in this case, everything's along on the long side of the market, I should say. Everything's worked out well. And again, on the right-hand side, there will be a function inside your rule-based observation about what the outcome might be. As this makes 4 in a row higher highs off the pullback here, and 4 in a row higher highs, does that constitute that this might be getting tired? Is it time to go? That type of thing. These statistics can be proven very, very easily. So we ask then, what's the game? We asked then what's the game and who to believe, and you'll notice myself and Ivan are down here. Do we believe the research, the CNB or Bloomberg, or myself or Ivan K? You'd be crazy. You would be crazy. So we're stuck in this place in the middle here where we're weighing up good news, bad news, we're weighing up the noise of the market, this, that of the market, that of the market, but we actually kind of need to look at the market and look into the market. So second choice is we can believe our own rule-based trading system. Like many games, it's about working out the odds and working with those odds to build a rule-based approach. So where we need to, in the first instance, sit down and work out what is the objective that we want to achieve. Is it, for example, is it a certain number of R per day? R against your risk. So is a certain number of R per day or per week or per month, is that my business plan going forward? Is it a certain amount of dollars per day, per week, per month? Do we want to capture a certain percentage of a movement in a particular movement? And I asked the question around this, well, catching it, how do you know how long the movement's going to be? You don't know that. And of course you can then use an indicator like a moving average or a CCI to capture movements and really work out whether that actually pays off or not. And the fourth one is to catch every trend of X particular size. And the fifth is to capitalize. Do we capitalize on every retracement in a trend? Some people, one of the homeworks came back, only had the short trades marked, so clearly interested in the short side of the market. No issue with that at all. So just to refresh on that, the number 4 here is to catch every trend of a position size or every movement of a certain size. Last week I sent out an email regarding this risk to reward ratio, or in this case we don't actually know what the reward is, but we really come back to risk. What is our risk to risk ratio? I'm going to come back to this slide as we move down. So our reward, of course, is potentially target. If our stop loss is not hit, our initial stop loss is not hit first, and then as we said last week, 2 weeks ago, the instrument still being alive, which is a futures contract or an options contract, that type of thing, and you're exiting at the target. So we'll take a look at this risk versus risk ratio. Now, I went through this game, if you like, this example of just simple data movements, and wanted to point out that in this top line here of these zeros, that clearly there's no market here. Clearly there's something going on here that only produces zeros. And the bottom line as well, there is no market here and only produces X's. And again, what looks like a market, we simply have a pattern of 0x and 0x, and really there is no market in this continuing line of information here. And then it gets what we think looks like a little bit more complicated, but there is still a outcome here of 0xx, 0xx, and so on. And on the right hand side we would end up with an xx on the top line, and on the right hand side on the bottom line we'd end up with 3 zeros after that as a continuation of this pattern, which is different from the previous pattern, but a pattern and no market. And then we get this type of outcome here. 2 different lines of information. Top line we have 0xx 0, x0, x0, 3x is 0, 4x is 3 zeros, x0, and really on the right hand side we could, going by the past information, we could have another 0 or another x turn up, and the same on the bottom, we could have an x or a 0 turn up as the next outcome on this little pattern. So what we often fail to notice or fail to appreciate often in market movements is that, oops, come back, is that there is so I beg your pardon, there are clusters of groups of the same, in this case x0. So here we have 3 x's in a row, so 4 x's in a row. So whatever's going on in this top outcome here has a potential to produce these 4 x's in a row. And on the bottom here we notice that there's 4 zeros and 4 zeros and 2 x's and 2 zeros and so on. So whatever's going on here has the capability of producing this type of outcome. So on the right hand side, clearly it has the capability of producing that type of outcome again. And what that looks like in price movement in this example, it could simply be zeros could be higher highs. So in this particular example, we've got 4 higher highs in a row and then 2 lower highs, XX, and then as the market moves on through there. So all it is a short outcome within a larger movement of price, but whatever's going on here has the capability of producing this type of pattern. So the game is understanding simple probability of a movement. Often market traders try and outthink the market. We've made that statement, and then make broad statements like it's going up. The game is, it's going up is like saying that we know what's going to happen in the next 60 minutes or the next day. And hopefully, in doing the homework, once you work in your charts and look at your charts and start to really consider each bar by bar, that, you know, sometimes we get these large range bars, promise bars after a shorter range bar, and then it's followed by an inside period, or it's followed by an outside period, or it has another bar following that on again. So when we look into price action, we really, in a sense, don't know what's going to occur in the next bar or the next bars, but we do need a way of dealing with it. So the game is understanding the simple probability of a movement, which is up, down, or sideways, and then the probability of that possibility. Now that occurs when you start to build some statistics, and I'll show you some of mine in just a moment. But the probability as a percentage of something occurring. So this week we looked through pivot bars, pivot points, and we could actually build statistics around, well, what's the probability of it following on for 1 bar, 2 bars, or 3 bars after that, or how often does it not follow on after that? And these are the, once you build those statistics, then it, when a position comes along that you may, for example, use a pivot point entry, then you know the probability of that actually working, and if it doesn't work, then it becomes easier to accept that that position hasn't worked, but there is another one coming. So I briefly talked about money management. I've got a question here, is what is your definition of account? Holding dollars for the instrument invested in. I might come back to that as we get towards the end. In this example, I've used a nominated $100,000 and a nominated 1%. So if our decision is that we're going to risk 1%, and then we nominate our distance to stop loss in dollars and cents, and I've just used a number of 32 cents, then we divide our $1,000, which is our 1%, by 32%, which gives us our position size. $1,000 divided by 32 cents gives us a position size of 3,125. In a SPY futures contract, again, if we decide to risk 1% of our account, $100,000 account, $1,000, we nominate the distance between the entry and the initial stop loss in points, and I've used a nominal 10 points to stop loss at $25 a point, therefore 10 points equals $250. So $1,000 divided by 250 gives us a contract size of 4 contracts in there. So it is a methodology of essentially standardizing of keeping your position size in relation to your percentage you're going to risk in your account. So as I said earlier, the game really is the reality of risk to risk. Now if we nominate a certain percentage, and I've seen, I'll go forward a little bit here and I'll expand on this a little bit. So the reality is risk to risk ratio, and when we work through our statistics, when we start to build up statistics from our just simple back application, how many trades worked, how many trades didn't work, how many trades worked for 1 bar after that, 2 bars after that, 3 bars after that, that type of thing, we can then build up statistics starting here, the number of wins, and then the number of wins in a row, and when we get a little deeper into it, does it work better at certain times of the day, or certain times of the week, or certain times of the month even. And then the number of losses, of course, and then the number of losses in a row, and does that occur around a certain time of day? Is there a higher probability entry if anybody trades the overnight markets? Certainly the European Open and the US Open provide lots of activity in the market, around the futures markets at that particular time, in the gold market as well, around those 2 opening times. That's when the move really gets underway and can produce a number of wins in a row or a number of losses in a row. We talked about the R level, the risk of an account, and in this example here, there's two examples of risk here of using a standard percentage size of the account. So simply, if the entry level here is at the top of this closing up period here, now a completed pivot point, if we nominate that as our entry point, and if we decide for inside our thinking, our rule-based plan, that we decide that we're going to place the stop here at the low, then the distance from the entry to the stop is simply stated as R. It'll be, if the stop is taken out, it'll be registered as R minus 1. We've taken out one full risk on the account. And again, if the entry is here at the top and we decide we're going to nominate the second low back in there, which is a wider, more distance in there, more cents if you like, or more dollars in there, then it affects our position size, comes into this calculation down here and changes our position size, so that if we do get stopped on the bottom one, we have still only handed over the same percentage of our account. It is this type of outcome will, if we consider, and I'll go to the next one here, one of the more interesting things in working in a office that offers leverage in there is sometimes, not often, but I don't get involved so much. In fact, I don't get involved at all in the client side of things, but often when they have their little risk meetings, it comes out that people have handed over a substantial amount of their account and more to the market. This example here is part of a gold study. I can show you the full study in a moment. It is part of the gold study, and there's a series of trades that are listed down here, and along the top here you'll see P and L. So it lists each profit that comes through, and then it lists each loss that comes through, and the loss as a percentage of what was risked, the percentage risk in there. So what I wanted to point out here is in this particular series just here, and I'll get my little pen out just to highlight it. In this series just here, there were 1, 2 break even, 3, 4, 5 break even, 6, 7, 8 losses in a row, and it resulted in a drawdown of 4.4%. Now, quite clearly, if you were risking 10% of your account if you're risking a full 10% of your account on each trade, and we're prepared to hand over 10% on each trade, then simply 8 losses in a row, and this particular RBT has the potential to produce 8 losses in a row. 8 losses in a row would simply wipe out 80% of your account. It's that simple mathematical example that often traders don't take on board when they're using leverage or looking at their potential risk in the market. And you'll see further down here there are 3 losses in a row here. Now you notice that the R minus varies, full 1R loss, 0.1 of an R loss, and it's to do with the stop loss methodology that I use in this particular RBT. Often the maximum it can take is 1R loss, but often the loss is less than 1R. I'll pull the sheet up in a moment and we'll have a look. But this is the type of statistic that needs to come out when you're looking at the markets, any markets, whether a future market or the equities market or currency markets, about if you've got an idea, if you're going to buy the breakout of something, how many times does that breakout fail and you end up with a loss of some sort. If you go through your chart and just pencil in some quite simple statistics, it will give you great insight into building a strategy around taking advantage, at least protecting your account is the main issue. What the outcome of that is the R return on that particular, I'll bring the sheet up in a moment, the R return on this particular RBT does show that there are some clear, well, painful, interesting drawdowns here. So we're at this area here at about number 120. We're up 32% at that stage, and there was a drawdown of about 7% in the account, and recently up here there was a couple of upticks in there, but essentially from around 55% up down to about 48% up, so a 7% drawdown again. So whatever's going on in there can produce this type of drawdown. The interesting thing is that this, the way that this started down here on the left-hand side, first trade went immediately into profit, and it really started to add on to itself as we went along. The issue can be, of course, is that your first trade can occur here, and we don't know that that's going to, no one knows what's happening in the future, of course, but it is quite a probability that on any rule-based system the first trade can occur here, and you can go immediately into a 7% drawdown on something that you have the evidence that produces a fairly, it's a bit of a rough equity curve, but at least an upward sloping equity curve. But it has that potential to do that. So would it then be better if we built an RBT and we actually consult that RBT in relation to our entry and exits along the way? Now, for our homework this week, we talked about pivot points. I just remind you again about this. I know I talk about this on the Mondays, on Monday mornings, and I talk about this pretty much at most talks I do, is around this very, very simple pivot point method. In here, it is worthwhile, I believe, building some statistics around that. In part of our homework in this past week, I had a look at this method on a blank 1 hour SPY chart. Found it very difficult to, in my approach to the market, found it very difficult to make any sense of it. So it saved me a lot of heartache potentially trading that, thinking I was seeing something that I already knew there, but the simple statistics proved that it was a pretty tough road to go. The other variation of a pivot point, and this is also part of our homework going forward this week, is that we start to notice that as the markets move down here into this low area here, this spike low, the following bar after that was an inside bar. It didn't break or didn't close above the high of the bar that makes the low. The following bar after that did trade over there but closed inside the high of that range of the bar that made the low, and finally the third bar out closed out here above the high of the bar that makes the low. Now I'll keep going. Then we have lots of variations, and this is really my intention of you doing the homework is really this in the first instance, is that you drill into your price action and into your price movements, and we can see up here, and I'll get my little pen out, we can see here there's a spike high here. We've got a high with a lower high either side of it, went in to form a pivot point at that point, and followed through for 1 bar down through here. It then produced a low with a higher low next to it either side, so there's potential pivot point coming up, and again right through here nothing is closed above that high through there, and then the market simply fell away. And we can see down here that there's actually a low area here. There's actually a high area here, I should say. It has a lower high next to it, lower high next to it, and this bar again here has a lower high and a lower high either side of it, and potential, each one of them potential swing points down, until of course this one finally closed out down through here. So when we look into our when we look inside our price action, we really want to notice what it's actually doing, and does it repeat itself, or is it repeatable going forward. So when we I'll go through this again just towards the end of the session, but when we look at the start to look at our what we call spike highs and spike lows that may or may not form pivot points. And we want to break down, last week we looked at plain pivot points where we said, okay, well there's a low and we wait for the bar to close over the high of that low, or there's a high and we wait for a bar to close below the low of that bar that makes the high. We now want to dissect our chart a little bit further and say that any time that there is a bar with a higher low to the left and a higher low to the right, we'll mark it off as a spike low. And anytime there is a bar with a high and a lower high next to it and a lower high on the right hand side of it, we'll mark that off as a spike high. And what we see is when we work through price action like this example here on the right hand side, if we work through this, there's a spike high in here, there's another one right next to it here, there's a spike low here, and then the spike high and the spike low and the spike high out through here, and down here we have the spike low and then the spike high, and there's another one right next to it as well in there, and sorry, in between there's a spike low as well. So we're starting to disassemble our price action into these spike movements that at any potential time they can follow through into a following on movement. And then once we start to join them together, we get this type of movement in our price, this type of price action movement. We join these spike high, spike low, spike high, spike low, and we start to see our trend and our little, as Ivan would say, trendettes along the way, and can really start to get an insight into what price movement actually is. All right, and I'll just quickly, we also looked at this concept around promise bars. And a promise bar is a bar that has a larger range than the previous bar. And in this case, a promise bar up has a higher low and a higher high than the previous bar. Larger range, higher low, higher high is a promise bar up. Larger range, lower high, lower low, larger range than the previous bar. Lower high, lower low is a promise bar down. Some of the homework came back with examples of that as well. That'll come back to that. That's our homework for this week. I'll very quickly see if there's any questions. Ivan, are you there at the moment?
I am. I'm watching you.
All right. Is there anything you'd like to add?
You're doing a great job.
Okay, thank you.
Looking at the individual bar movements just really shows the road potentially ahead. To do that, one needs to focus on the last bar and not have 65 million bars on screen. Most people have 65 million bars on screen.
Yep. Yep, yes, yep, I've noticed that. We've got a strange, not a strange thing, we've got an interesting thing in the office where the sales guys trade, and they trade all different sorts of things, currencies and stocks, and it's quite interesting. Some of them I talk to and say, look, have a look at this and take a look at the right-hand edge and let's get all this stuff off here. And you look back 2 days later and there they are with 500 bars on their screen again. trying to work out what's going on. The guy that
old habits die hard, right?
yes, they do. There's one chap in the office who has listened a little bit, and he's starting to now ask more and more questions about particular setups and about this and that. So he's really, and I noticed that when he opens up a chart now, he basically puts 15 bars on his screen. When he says, can you have a look at this, or what do you think of this, or can you show me something here, and straight away he goes to that, which is quite encouraging. And he has some interesting results.
Normally, Gary, what I've found is maybe 1 out of 10 people take the ideas on board, and 9 out of 10 stick to the old ideas.
Yep. Yeah, that's, yeah. And I must say, even the road I've walked with this, Ivan has clipped me over the ear a couple of times about, because I've had a fairly textbook education in TA, and Ivan's really pointed out some very, very different and provable concepts in the market that are starting to come to fruition. So it's, even for me, it's taken a little bit of time. Now, very quickly, I mentioned that I would show my results here. This is, I'll open this up. This is, I did show this, I think, in Melbourne. This essentially is a study of, and I'll come down here. I've got a little bit more time to look at it now. This is essentially a study of gold based on a 3-hour chart. And what I'm looking for is this, an inside period. Irregardless of what has occurred before it, but simply an inside period. And I have about 6 months of data here, about 1,800 and something bars on there, but it's simply based around this idea, if you like, and it requires that a buy order is placed at the high of the inside bar and a sell order is placed at the low of the inside bar. And whichever one gets taken up, that's the way the trade goes. The methodology is it is simply closed on the very next bar, win, lose or draw. So the close, so we come back 3 hours later and it's either been stopped out or it's just closed whatever that value is on the next bar. So there is a study here of essentially 200 inside periods inside gold. It started late December last year, and the last entry is about the 30th, about 2 weeks ago. It has produced, as I mentioned earlier, some interesting results. What we're finding, as I pointed out on an earlier slide, there are a series of, this is this column here, the I column is the actual losses recorded. In here, there's produce a series of losses in a row. And then again here, 1, 2, 3, 4, 5, 6 up here. And when you look back, 1, 2, 3, 4, 5, 6, 7, 8, 9 losses in a row, that type of thing. And it has the opposite effect as well, 1, 2, 3, 4, 5, 6, 7 wins in a row, that type of thing. So it has the capacity to produce both sides. What makes this, the only thing that makes this work is that the losses are contained, and contained to one length of the bar, which equates to a certain percentage of the account, and then the upside is often larger than that. So when we look through the statistics in the actual loss value, we can see that the losses are $3, $6, $1.53, $3.46, and the gains are often $4 and $5. There's one there for $26 and so on. So the loss is then equated back to a percentage of the account. What I've found, and people often ask the question, well, what happens if the market changes? What happens then? What I've found recently, and it was around the Brexit period, around the 23rd, you notice here, 17th, leading into Brexit the week before, and then Brexit here on the 23rd, and it actually missed the move on the gold during the Brexit move, fortunately. But what started to occur here is the following an inside period, there was an outside period, which meant you took two losses. You took a loss on the short position and a loss on the long position. Now this is raw data. There are ways of working around that, but what this has done now is this has alerted me to, well, we really need to look at this now. We really need to deal with this outside period, because it's starting to come up on a regular basis. Now it may die away, but that also statistics show me that it is now a possibility that outside periods immediately following an inside period are a probability running, and I wrote it down here somewhere, 24% of the time. So 1 in 4, 1 in 5 bars after an inside period turns out to be an outside period, which is a double loss, recorded as a double loss in my notes here. Yep.
Gary?
Yes.
When a market breaks the low of an inside period,
yes,
you go short.
Yes.
Then when it breaks the high, it's a 1-hour loss.
That's right.
If it continues going higher,
yes,
it may be a 3-hour win.
That's right. And that's
an outside period following an inside period
yep.
doesn't necessarily mean you have a 2-hour loss.
That's right. It doesn't necessarily mean, but sometimes it does. And this is the point I wanted to make.
This is where you need to zero in on a smaller time scale.
Yes.
To see how often the market breaks the low, breaks the high, and then breaks the low again.
Right. Exactly right. So good answer.
Called a whip.
Yes. Yeah. Who doesn't know about that? The first point I wanted to make is that they showed up regularly during an potential economic event, which turned into be an economic event. They started to show up on a regular basis, as opposed to the past where they showed up randomly out through here. So it was an interesting exercise. So there needs to be a way now of, so clearly the road forward on this now is to deal with this particular occurrence in there as a way of dealing with it. And this would then certainly improve this percentage R return curve here, and also the equity curve, points return I've got here, the actual dollar return on there. So it's shown in my example 103 wins, 95 losses, and there were 13 break-evens in there. So it's been a very, very interesting exercise. It shows that trading gold during lunchtime, our time, and about 3 in the afternoon is really a waste of time. That came out through the results. Most active time is the European Open and then the US Open. Then anything after 3 a.m. in the morning is also a waste of time as well.
You should be sleeping.
You should be sleeping. Yep. So it sort of now works out, well, okay, are you prepared to commit to that to get these sort of returns? And I'll just quickly, I know Ivan doesn't like this, but I'll say it anyway. In this case, it's produced $160 cash return on their dollar amount.
Gary, that's excellent given the equity curve.
Yep.
That's a stellar return.
Yep.
Take that to the bank and ask them to lend you $1 million, and they'll go, that can't be real.
That's right. Yeah, that's right. Yeah, based on one contract, yeah, it's an interesting outcome. So I'll just quickly go through a couple of the homeworks, just point out a couple of the homeworks here, in no particular order, I should say. Some of these came back with some interesting results. What stood out for me, and I think Ivan may have a different insight into this. There was clearly, we talked about pivot points last week and a few other things, so clearly there's still some misunderstanding about what they actually are. I mentioned earlier some people have preference to go short. This example here clearly shows the short in there, and so there's a bit of a trading plan written around here. I'll find another one was really also quite good. Is this example here? This was rather interesting. This one here, the entry rules for a short position at a pivot point: count back 3 bars from the swing high, and the triggers when the price closes below the low of the count back bar. So clearly he's set out a series of ideas, rules, if you like, with the stop loss in here, and work through the chart, simply marking them off as he went, and or she went, he went, and wrote down the results on each page. Simply work through them, wrote down the results, entry, exit, so that you build up a series of statistics like this. When it gets to the right-hand edge, when it comes time to take the trade, you have some probable statistics to work with on a potential outcome as far as potential movement of price movement. And if you work through this example here, there were many that simply followed through for 1 or 2 bars and then reversed and or did consolidated or did something else along the way. So it's good good start to the there's a homework there. Good start to putting something together. A really good start to putting something together. I'd take those lines off there, but and focus on the price action, but a good start nonetheless.
Gary,
Yes.
one comment from my side.
Yes.
To have a stop loss based on the close of a bar being somewhere below the low or above a high means you have no stop loss in place at all.
Right.
Because the market could close $1 million away. So you've got no control over your risk at all.
Yep.
And it's a really dangerous road to walk down.
Yep. Yep. I found that out firsthand. As everyone knows, I run a small account in the office, and one of the stop loss rule is to close at the end of the day. If you get a closing price past at or past your stop loss level, and that is exactly what I found out, that the stop loss can vary greatly. From, substantially from where your intended stop loss is to where it actually closes on that day. Agreed.
Which is okay if you're in profit, but as an initial stop loss,
yep, to
say I'm going long, and if the market closes below the bar of entry,
yep,
that's dynamite.
Yep. And it was in this particular example of mine, it was done to stop the whipsaw during the day. Was done to alleviate that. Now the jury's still out on whether that's a clear outcome or not, so I'm still working on that. But it's yeah, interesting outcome. So I'll move this.
Beware of the black swan.
Yes. Yes. Beware.
Especially in futures where you have limits on the movement.
Yep.
And a limit movement down, market stops trading for 1 hour or for the rest of the day.
Yep.
And then opens again the next day. So it could be double limit down.
Yep.
And then triple limit down. And that's really dynamite.
Yep.
Potentially.
Some of the other homework that came through, structured into some nice layouts in there. I haven't captured the charts here. My apologies. I haven't captured the charts in this, or hasn't come through in this grab. But at least it's starting to assemble assemble a potential understanding of the market that's being studied. So I won't go through all the homework there. I do want to get on with just a couple of other things here. In your go-to box, right there is a little Word document again in the handouts area. It's just an outline of where I'd like to go this week about the spike highs and spike lows, and I'll come back to that in a second. Any questions there? Are there any questions? Is everyone good with questions? I was just mentioned again, some of the homework was incredibly detailed. We've noticed that, we appreciate that, and it really is a good step forward in understanding price movement and the market you're looking at. We looked at everybody's homework. We couple of quick discussions around a few of them, but looked at them, every single one of them. And if you haven't done your homework and would like to submit it, would you please get it in this week. So to sum up again, the objective of this approach, if you like, is to work out a rule-based approach. The first part of the objective of this is to state what you want out of this. What do I want to get out of this? And then step in and see if that market will produce that for you based on your study of price action. So in here, is it a certain R per day or per week or per month, a certain return, percentage return per day, per week, per month? Is it a dollar amount per day, per week, per month, that type of thing? Do you want to capture a part of a movement, potential movement underway, which can be done with simple indicators or that type of thing? And of different types as well, moving averages. Sometimes a ATR will allow you to do that. It needs to be back tested, but an ATR or a CCI will allow you to do that. To catch every trend of a certain size, a particular size, or capture every retracement, looking for the pullback type of trade. So the rule-based systems.
Gary.
Yep.
All the previous slide gets back to is I guess the belief structure of the individual looking to trade.
Yep.
Are they looking to trade for a income stream, or are they looking to trade whatever movements are there, but getting the income stream?
Yep.
Are they looking to be trend traders, or are they looking to be top and bottom pickers?
Yep.
And everyone is different in that context.
Yep. So the first intention of going down this road is to stop, or I guess try and point out that often people step up to the market ready to take a swing and a hit, and without any real understanding of what they're taking a swing for. If they take 3 strikes, they can often be out, and this is about building a system that if you take 3 strikes, you're not out. You're still in the game, and you still have the ability to move forward in there. So it's breaking it down into biteable bits of a trading approach. So the system, a rule-based system, are built on proven observations, the statistics of an event, the entry technique, the position size, the risk as a percentage of account, and your type of exit. And some of the homework came back with different types of exits tried out. We read through those, they were terrific, and I would encourage anyone that's starting out down this road, as simple as even if you scribble it on the sheet, just different types of exits, and see if you get different results, and you'll then enter into this world of statistical approach. So I've got a couple of slides here that really to get started on this. Yes,
Gary, the first part's really important. The stats of an event.
Yep.
How often does an event occur over 100 bars or 1,000 bars?
Yep. Yeah. Well, the example
that becomes really important.
Yeah. So the example was the inside period on the gold chart. So there's in 1,100 bars, it occurred 192 times. You know, it's so it's not a regular thing. So the question is, do you define an RBT for a particular stock only or for a sector? If you looked at an RBT, if you particularly in stocks, you have your small volatile stocks that can trade 20 and 30% per day. Clearly you need a different exit technique or a different entry technique as to what you would be looking at something like Telstra that trades 1% if you're lucky per day. Either in either direction. So yes, RBTs are built around the instrument you're observing, particularly in the futures market and the currencies market as well. And you can see, if you simple observation, you can see that the euro trades a little differently than what, say, the pound does or the Aussie dollar does. So it's still, you can take a technique and apply it to all of those things, but at least prove it out that it actually does work for you. I've got a couple more here that I wanted to just point out. So the basis, the beginning point of all of this is, my idea is, and as we saw in some of the homework, some people wrote down their premise, what they're looking at, and it's as simple as writing down that, what your entry is, what your hold is, what your exit is along the way, and then some simple, you can build some very simple statistics around that into a little graphical chart like this. The great place to start is my entry is, my stop is, my exit was, and was the first bar profitable, was the second bar profitable, was the third bar profitable, and just simply put yes, yes, no, no, that type of thing, or a tick, tick, cross, cross, and work out how many times you were profitable in the first bar and how many times you were profitable in the second bar after that, whether it's a 5-minute chart, 5-minute charts, a 30-minute chart, an hour chart, or a daily or a weekly or a monthly chart along the way. Now, one of the studies that I did inside Metastock, Metastock, and this is not a plug for Metastock, it's just something that has come up. Metastock, as you know, on Mondays I talk incessantly about the candle numbers and types of candle, that type of thing. Metastock numbers them out. So what I did was I went through the S&P 500. In here, this is the S&P 500. It's on a weekly basis. You can see down here it's on a weekly basis, and looked at the candle numbers because, you know, I talk about it every week. So what are the numbers? I went through the numbers on the S&P 500. I went through 300 bars on a weekly basis. So about 5 years, a bit over 5 years of data, and looked at the candle numbers and what they actually state. And candle number 4, it turned up only 7 times in 300 bars. On the first bar, it was only profitable 2 times. The second bar, it was only still profitable 2 times, and the third bar, still profitable 2 times. And so, very simple as it is, but it gave a particular outcome. You'll notice on Mondays I often rabbit on about candle number 12, which is a down close shaven base candle. Everyone is short the market. It turns up 14 times in 300 bars. 10 times out of those 14 there was a green bar afterwards, and it's actually described in the notes as a bullish bar, and the statistics prove that to be so. Again, candle number 12 turned up 14 times, and 14 out of 14 times at some stage during the next week the market was higher than the Friday close. Quite a staggering result, only a sample of 300, but an interesting result along the way. So this type of simple statistic proving makes you a lot more comfortable at the right-hand edge and gives you a lot of understanding at the right-hand edge about this business that you're involved in. All right, and someone did their homework on this, I must say, as well, which is terrific. I've read through it and it looks really, really good. Okay. Questions. What about a set of sequences of candles, example 2 followed by 7? Don't say that, John, because I'll ask you to come back to me next week with the statistics on that. The candle method that's used on Monday is simply a week by week method. It's often nothing more than that. Are there any more questions here? I'll just see if I can swing the homework. Just see if I can swing the homework up, and I'll just go through the homework this week. it is much easier. Whoops! It is much easier than last week's, I'll say. It's in the download box you've got on your screen. Okay, here we are. Okay, this is the cheat sheet from last week. I've simply updated it a little bit. You'll notice down on the left-hand corner down here, down the bottom, there is this little graphic here, and I have marked the spike lows and spike highs on there. The homework this week is simply this example here, is to take only 100 bars this time of information printed on 2 sheets, any market, any time frame, and just record out the spike highs and the spike lows along the way. As simple as that. And if you could send that back, would be very, very good. Would be very encouraging for us, and will also again give you some insight. So when you start to record now the spike highs and spike lows, you'll start to also intuitively, hopefully, notice the pivot points along the way, and how often, in some cases, spike highs can follow each other, spike lows can follow each other. Statistics of returns, yes, if you'd like to do that, would be terrific. You can also, in this down the bottom here on the right hand side, I've got just a beginning again of recording some statistics around pivot points, outside periods, and for bar closes in the top or bottom 25%, the number of times it does it in for example 200 bars, how many times on the following bar is it still profitable, the following second bar is it still profitable, third bar is it still profitable, and you can simply write out your profit and loss here on the right hand side. Very, very simple to do, and I would encourage you to work through these simple statistics, and it will change the way you look at price action along the way. I have to say that I find one of the most irritating things about my job is people ask me, what do you think of this stock? And I'm kind of like, well, you can actually work it out yourself by doing some simple stats around it. You can actually come up with your own answer, because I can guarantee you mine, unless I've actually done the statistics, my answer is basically useless. So this is to set yourself out on the road of self-sufficiency, if you like. It's that, what's that saying they had? Teach someone to fish and they'll eat for life or something. So this is it. It is important that you do the homework. It is important that if you're stuck with the homework, you give me a call in the office. Everyone's got my email address and my telephone number. And if you don't get me on the phone, just simply ring back. That's what this 3 weeks is about. So thank you everyone for coming out. I'll finish there. Thank you, Ivan. Ivan's not there. Oh, Ivan's been muted again. Sorry, you there, Ivan?
I've been muted or muted?
Muted. This is wonderful, this GoToWebinar thing. Okay, so thank you everyone. If there's